So Alex, first of all, welcome to our session tonight. Great to have you with us. And of course, my first question to you is tell us about rebellion research, your experience running the fund and how to adopt the AI strategies into your trading.
I've been developing machine learning in general since about 2000. And then starting around 2002, 2003, I started thinking about machine learning for investing. And I was very inspired by the long-term capital management blow. Long-term capital management was the largest hedge fund in the world, and it blew up in spectacular fashion in 1998. And I thought to myself, could I program the inverse of that strategy to perform over a 50-year period? Because if I was ever going to build something, it was something that had to last for a very long period of time. It was something that, I felt could, I could believe in how it was operating. And so I had the idea of building a machine learning for global economic predictions. And then from those economic predictions, creating portfolios, which now, we offer to our clients through hedge funds and robo-advisory. But when we first launched, actually, we used a deep learning system. The initial system was from my partner, Dr. Spencer Greenberg, who some people might know Jan LeCun, who's a well-known deep learning professor from NYU. Jan was my partner's PhD advisor. And so, we started working with neural networks and deep learning very early. But the problem with deep learning in finance is very simple. Deep learning, what is it good at? Facial recognition. So it can look at a face with a million different distinct features and say, this specific face is Michael Jackson, based on 9 million features that are specific to Michael Jackson's face. But when dealing with the economy, it's changing at every given moment. It's slightly changing. In 1990, Australia had maybe 4 to 10% export to China. By 2000, grown to like 20, I think by 2015, 2020 now, Australia, half of its economy is essentially China. And so how does a simple algorithm look at the relationship between Australia and China over the last 30 years? It can't, because it's been an evolving entity. Think about Apple. When Steve Jobs came in to take over Apple, it was building garbagey computers. So the Apple stock of 1995 is nothing in common with the Apple stock of 2010, and maybe much more so 2010, 2020. But the point is, if you have what finance is constantly evolving entities in a solar system. See, a solar system, at least the planets are dynamic but stable. And so when you look at Earth doesn't really change very much. It moves in its direction relative to the sun, but in terms of the economy, let's say Earth is, China. China's economy is moving much more so than Earth's dynamically changing relative to the rest of the solar system. So my point is that from Apple to China to Australia, finance moves much more quickly. And so deep learning is slow. And so we actually about 10 years ago moved from deep learning to deep reinforcement learning. And so deep reinforcement learning, we're able to look at 25 years of data, but it's much more of a chess-like machine learning system where it's trying to find very similar kind of options to answer a question. For instance, I see a strong economy and I see central banks buying lots of debt. So I want, mid-cap banks in these countries. And so of these 7 or 8 banks in, South Korea, Argentina, and America, which of them are the best? Well, this particular bank, ABC, has the best cash flow, various ratios. But the point is that with reinforcement learning, it's much more of a superficial question. And so you'll use a lot of deep data and you'll have kind of predictions built on deep data, but the final decision maker can be very simplistic. And so think about, Mercedes-Benz versus Ferrari. The machine learning will like global auto demand. It'll say global auto demand is fantastic. We like it, yada, yada, yada. But Mercedes-Benz is not quite growing as much as it has been, and their margins are compressing, versus Ferrari, though Ferrari is much more expensive and you're paying 50 to 70 times a PE ratio, Ferrari has consistently had a high PE ratio. And so finance is all about, the difference of relative value. So Tesla, when Tesla was a $25 stock, what was its revenue? Very little. And so Tesla has actually had a somewhat consistent 20 to 50 to 100 times revenue number. We don't actually own Tesla currently. We don't own Tesla very simply because a big part of how we trade our Rebellion Research is with confidence ratio. Confidence ratio is the expected probability that forecast will work. And so we use probabilistic neural networks, which were developed by a friend of mine, UCLA professor Judea Pearl. Judea is a great guy. We talk all the time. Judea has actually been giving me a lot of ideas for new research. But the point is that our machine learning was really only invented in 1991. And it's much more of, I like gambling. I have always enjoyed poker. It's extremely fun for me as someone who deals with the numbers. And I don't really want to talk to other people. I'd rather kind of watch their facial expressions and try to take it in and register correlations between certain facial expressions and certain performance in the game over half hour to an hour. A good poker player can not just read cards, but can also read faces. The combination of the two can really yield better than average results. So, but for me, poker is nothing different than tennis or golf. I play it as I play a game. Nevertheless, that is how I approach my machine learning for Rebellion Research. And that is also why I didn't like deep learning and why I like reinforcement learning. So when you're dealing with probabilistic machine learning, every time you come up with a prediction, there's a high knowledge that there's going to be a failure in that prediction. And so, I decide that I like British Airways because I like global aviation. I see global, aviation numbers rising for whatever economic reasons. Actually, currently, RAI does not like aviation right now. The valuations are, I can tell you because people have been asking, in our machine learning's view, global airline valuations are too high relative to how long it will take for the passenger numbers to come back. People are expecting by the end of 2023 to actually get back to where we were in 2019. And so that's fine. And maybe we have more efficiencies, but, we also, by the way, oil's been rising, which is, a major, negative indicator for aviation. That's also, by the way, very much how our machine learning will work, in that when it puts together its 100 to 120 best possible predictions, it looks for predictions that work when other predictions don't work. And so what that comes down to, let's say the AI doesn't like oil, but it's not sure that it's going to be right on oil. And so it could look to something like a CNOOC. So CNOOC is actually, the AI loves CNOOC right now. CNOOC represents extreme value. It's at a deep discount to its 5 and 10 year historical valuations, while CNOOC's profits come from a rising commodity, crude oil, which the AI is also cautiously optimistic on. And so when you're dealing with cautious optimism, you have to mitigate risk as much as possible. So if you have a high tide and all boats rise, you can afford to take more risk. and take the riskier boat who will end up going up the most. And so, for instance, if all steel companies are getting much higher steel prices, you can go with the weakest steel company because the beta, the differential of goodness to badness, badness to goodness, will change. And that is the market. The market is all about the change in goodness to badness, badness to goodness, relative to market participants' understanding and expectations of that goodness to badness. Essentially, it's all about expectations. And so the company does badly, but not as bad as people thought, the stock will rise. Hence, why it's very important to understand where the market expectations are. And so, that's an issue with value.
One follow-up question here. So your machine is, optimistic about oil and oil stocks. Do you have to personally price in the macro events coming up, like Middle East tensions and inventory data in the US? Do you actually?
Well, that's a great question. Do we look at macro events? Yes and no. We look at risk that's in the marketplace and how the market's accounting for risk and what we see coming across, but it's almost impossible to forecast what will happen. You have to account for what is kind of going to happen. And so what I mean by that is that we feel we can't really predict beyond 90 days, and anything kind of under 3 weeks is noise. So in our research, in our view, you can only really consistently, this is for by the way, this changes. So for Greece, for instance, not to brag, but our machine learning over 1 5-year period had a 90% accuracy for calling the Greek markets because it was so easy. Anyone on this webinar could have called the Greek markets if you saw how it moved. And that's something else we got a lot of credit for was the Greek financial crisis. But in 2009, you had France, Germany, Switzerland, economic data doing this, and you had Greece just in the opposite direction. But the AI is completely dispassionate. So, like I said, there's no human interaction. But how did the AI know that the Greek markets would crash? It had a lot of Greek economic indicators, retail sales, export data. And so, for instance, with the Greek debt crisis, it took about 2 to 3 weeks for it to see the Greek issue spilling over into the rest of Europe. And that's, by the way, that's sped up. That was 2010. Today, it's quicker. It can be 10 to 15 days. We'll see an economic event change. But right now, it's a very interesting economy we're in right now, where there's just been so much capital created that you have a few issues where you have few alternatives for capital. Because you have to remember, a big part of investing is relative performance and relative expectations. So even if you may not like the US economy, the 10-year note might yield way better than the German or Japanese or Chinese note that you consider alternatively. And so you have to look at the alternatives. And when the alternatives are weak, you have to consider what to do. But right now, the US economy is extremely strong. And even, there is some weakness in China, but at the same time, China is still very strong. And so it's like, if you're looking at a wave, sure, it'll, do this, but how is the overall economy of China relative to where it was 5 years ago versus the markets? So yes, what our machine learning sees is that the Chinese economy is slightly slowing right now. However, the valuations of Chinese stocks are insanely low. And so you're getting a good bargain for your investment. And so, we actually do still like the Chinese markets, and we feel that you're getting a good value. Is there inherent risk in the Chinese market? Yes, there is an inherent risk. But when you're searching for risk in a time when you've got a generally good economy, it's a good place to go.